It's time for Yahoo Finance's Market Minute. Stocks are falling after President Trump announces increased tariffs on Canada. Airline stocks mostly under pressure here. Southwest is the only one in the green. It's after issuing cautious outlooks. Delta, Southwest, and American all cutting guidance for their current quarters, citing weakening consumer demand amid tariff risks and economic uncertainty. And coal shares, they're plunging as the retailer issues weaker than expected sales and profit guidance. Coal's also cutting its dividend as the new CEO looks for ways to cut costs and turn things around for the troubled company. And shares of Oracle falling after missing Wall Street's estimates for earnings and cloud revenue. Companies saying it signed new cloud agreements with companies like OpenAI, Meta, and NVIDIA, expecting this to boost revenue by 15% in the next year. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. They say check in on your friends, and we're doing just that, folks. We discuss how investors can position themselves as the market looks to recover from Monday's big sell-off, but that has stalled. We'll get into that in a second. And we'll dive into what small business owners are saying about the economy and the prices that you'll pay at their stores in the coming months. Plus, it's tax week on Wealth. All week, we'll be covering everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. Today, we'll focus on your refund. Yeah, the fun part of it. All right, all that and much more coming up during today's show. But first, we gotta take a look at some of the market action. We are 90 minutes into the trading day, and after starting off the day mixed with a tinge of positivity, stocks right now are in the red handedly, following President Trump's announcement of more tariffs on Canada. This follows yesterday's steep drop driven by recession fears. Joining me now, we've got Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager. I gotta know, how are you assessing this volatility right now and what seems to be like just a flood more of tariff talk coming out of the White House?
A lot of what we're seeing in the markets, sometimes when we think about the policy environment, it's almost as though the president has, two angels, the two angels on his shoulders. You have the good Trump policies, which are tax cuts and deregulation, alongside what, at least economically speaking, oftentimes is the bad Trump, meaning the tariff news. And early on post-election, I think that you saw kind of the good angels winning out, and what the markets have been demonstrating of late is that really there's been an increased focus on the tariff side, and that's bringing the markets down, it's bringing in recession or even stagflation fears. And when we think about a playbook for this, you say, well, okay, first of all, when we think of trade wars, there aren't any absolute winners. It's just a question of who loses less, relative winners. And so some of the things on a relative basis that have been doing more poorly would be some of the big tech names that are more trade oriented versus names that are areas of the market that are more inwardly focused would be areas like small caps, staples, utilities, healthcare. And really what we say to investors, the biggest concern on a macro basis is whether the uncertainty around trade policy causes companies to limit capital spending and limit hiring. It's sort of we've had a lot of this on again. We're having tariffs, we're pulling them back. Tariffs, giving a pause. I haven't seen as much on again, off again. It's sort of like Ross and Rachel on the TV show Friends, and companies don't really necessarily like that level of uncertainty.
As we think about the uncertainty right now, a lot of it still stems not only from what are the policy announcements, but also what some of the retaliatory efforts might look like as well. And as that lingers and eventually becomes more known by the markets, how are you expecting this broader trend of what we've seen in the great reallocation or the great repositioning, if you will, as some of the economists and investment strategists have called it?
Yeah, a lot of what we're seeing in the markets, sometimes when we think about the policy environment, it's almost as though the president has two angels, the good Trump policies, which are tax cuts and deregulation, alongside what the markets have been demonstrating of late is that really there's been an increased focus on the tariff side. And what the markets have been demonstrating of late is that really there's been an increased focus on the tariff side. And Yeah, the biggest thing, and I think one of the area that we tell our clients to focus on more than anything is on a macro basis is how does this impact Fed policy? That's really the world we've lived in, ever since the Fed put was incepted years ago. How does it impact Fed policy? And is the central bank going to focus more on the economic slowdown aspect of tariffs, which tends to happen over the longer term, or their inflationary aspect, which tends to be a little bit near term? And to the extent that they do look at it a little bit more on the inflationary side, that might cause them to maybe pause a little bit longer with respect to rate cuts. Now, as far as what the market's telling us, the market seems to be saying that it's really the economic slowdown that's a bigger impact, given the fact that in the last month or two, you've seen the projected number of interest rate cuts this year go from 1 to 2 to 3 cuts. And likewise, we've seen the 10-year bond yields come down. And so that's the market's way of saying that, as well as the rotation into more stable areas of the market just says, okay, recession fears are starting to creep up a little bit.
So for a lot of investors out there that are trying to understand with this dip, if this is an opportunity or if there should be more caution ahead, what would you say to them? Is this a dip buying opportunity, or is there more that you expect in terms of some of the declines given the volatility that we've been tracking?
It appears that investors should probably, at least given the degree of uncertainty, brace for a continuation of that. And so that's one reason we've seen what may just be the beginning of a rotation into some of the safer areas of the market. One rotation that could be a bit more sustainable would be you've seen value stocks as well as dividend payers have been doing a bit better this year. And that kind of makes sense. You look at dividend paying stocks, these are the kind of names for which where are you getting your returns from? You're not necessarily getting it all from capital gains. You're getting it from that cash that companies are returning to shareholders. And so, capital gains can be positive or negatives, but, dividends are always positive. And so, that rotation could be just beginning.
Burns, thanks so much for taking the time here with us today.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Today we're looking at the top 3 trending tickers on Yahoo Finance. First up, Tesla, looking to rebound after Monday's big sell-off. Shares closed down 15% yesterday. Shares are up 4% right now. President Trump shared his intent to purchase a brand new Tesla today in a Truth Social post, saying that the left is trying to illegally boycott the company. Shares of the EV maker are off more than 40% so far this year. Next, Delta Airlines cutting its profit expectations by roughly half for the first quarter. The airline citing a dip in consumer and corporate confidence and softening demand amid macro uncertainty. The airline not alone in slashing its forecast, as United came out today saying it's also seeing weakness in travel demand. Shares of Delta are down 8%. Finally, shares of Kohl's down 21%, sliding after the department store's mixed fourth quarter earnings results. The retailer says it expects a larger than expected drop in comparable sales in 2025. The company's CEO says changes over the past few years to attract new customers cause some friction with their core customers, and they need to reprioritize initiatives to better serve all customers, both new and existing. The selling continues on Wall Street today after markets were pummeled Monday. Investors' worries about economic growth deepening after President Trump announced he's raising Canadian steel and aluminum tariffs to 50% in retaliation for Canadian duties. Monday's sell-off wiped out nearly $1.4 trillion from the S&P 500 and just over $1 trillion in the NASDAQ 100. And if you're frantically checking your portfolio this week, you may be in the company of billionaires. We saw a number of billionaires' net worths take a massive hit on Monday. The top 3, according to Bloomberg's Billionaires Index, are Tesla CEO Elon Musk, Meta CEO Mark Zuckerberg, and Oracle founder and CTO Larry Ellison. With Tesla shares closing down 15% Monday, Musk lost $29 billion in net worth. Tesla shares account for a little less than a third of Musk's wealth. This year so far, Musk is down nearly $132 billion. Not exactly chump change. Zuckerberg lost $9.5 billion on Monday. The majority of his wealth is tied to Meta. Despite Monday's losses, his net worth rose by $4 billion in 2025 so far. As of Monday's close, Meta is the only Magnificent Seven member holding on to green territory year to date. The third biggest loser from Monday's sell-off was Larry Ellison, who lost $7.3 billion, and the majority of his wealth is in Oracle, but he also has a $10 billion stake in Tesla. Well, stocks are lower once again today after President Trump announced an increase to tariffs on Canadian steel and aluminum, accelerating losses after Monday's brutal sell-off. The Nasdaq fell 4% then. The S&P 500, that was down 2%, and investors feeling uncertain as escalating trade tensions and weakening economic data spark fears of potential recession. So, how should investors navigate the current market? Joining me now, we've got Larry Sprung, who's the founder of Midland Financial and author of Financial Planning Made Personal. Larry, good to have you back on the program. How are you advising people near retirement right now to evaluate some of the volatility that we've been tracking tied to policy coming out of the White House?
Yeah, great to see you, Brad. And I think first and foremost is you don't panic. Volatility is the price that we pay for investing. It's as easy as that. But the important thing here is to make sure that you're level setting, checking your plan, and making sure that the plan still works even in a protracted downturn. You know, make sure that you're on track to reach those goals, review that current allocation. And I think just as important as those with regard to your plan is make sure that you have an emergency fund. Although we don't think recession is on the way, be prepared just in case that you have some extra cash set aside for those emergencies should they arise.
So what about those that are earlier on in their investment timeline and further away perhaps from retirement?
Great opportunity, right? And these opportunities present themselves not too many times over your lifetime. So it's a great opportunity. Look to perhaps accelerate IRA contributions that you are looking to make this year. Accelerate 401k contributions if you're planning to max out. Maybe add more now and then add less later on to take advantage of this dip. Take advantage of that. Make sure your plan is on track. And if you don't have a plan, get one. And similarly, in case, again, we're not in the camp that recession's coming, but if one were to come, make sure you have that emergency fund in place just in case. It's a good thing to have in all markets.
And so what is the mindset that investors are apt to keep in mind, even as they're considering what their time horizon across any age might look like?
Yeah, so I think the interesting thing is, and we forget in times like this, what really actually takes place. Going back to 1990, the S&P has averaged 9.8%. And if you miss the 10 best days, typically there are 10 days across the year that make up the lion's share of the returns for the year. If you miss those, then your return goes down by about 12.5% into the negative. So the whole idea is to maintain your investment philosophy, make sure that it keeps you on track. And remember, some of the best days we see in the markets happen to be clustered right around the worst days. So, we might have some of our best days of 2025 coming here shortly.
Now, what if you just retired? I was speaking with someone just at the beginning of the week, actually over the weekend, about them just commencing their retirement after 36 years working at NASA. And say you've built up that nest egg, you had that retirement and the savings, especially with your investments that you were looking to kind of draw from. What now?
Yeah. So two things I have to say to that is you should plan for that in advance. One thing we do with the families we serve is we run a, bear market test, meaning we run a scenario that if the market were to decline similarly to what happened in 08, 09, when it was arguably, one of the worst markets of all time, how would that have affected your retirement if those 2 years followed your retirement date, which is exactly the scenario you're talking about. And we run it through those scenarios to make sure they're sufficient. If you're in the midst of that, remember, this too shall pass. And the reality is that although you retired now, the reality is that that money is going to have to last you for a very long time, most cases 10, 20, 30 years. So you still have a little bit of a longer term time horizon, and make sure that you have some money positioned for short term, some medium term, and some longer term, so it's not as volatile as all, having all your assets long term, if that makes sense.
Larry, good to see you. Thanks so much for joining us again.
Thank you.
Let's get a quick check on the markets here as we are just inside of 2 hours into today's trading session, and taking a look at the Dow and the S&P 500 still in negative territory. You're seeing, though, the NASDAQ actually bounce back into the green right now as we are taking a look at that, flat just barely to the upside. We've seen a significant effort in order for that to take place. We'll see if we can hold on to those gains in what's been a very oscillating type of day for the tech-heavy average, as it's touched both positive and negative sides of the trade. Coming up, we're taking a look at where things stand in the labor market. We've got ZipRecruiter's chief economist joining us next on Wealth. The number of open jobs in January was higher than anticipated at 7.7 million, signaling a steady labor market at the start of 2025. Although backwards looking, the JOLTS print provides a crucial baseline for the U.S. labor market before President Trump's policies began. A federal hiring freeze, widespread layoffs, and ever-changing tariff plans have since injected uncertainty into the market, reigniting recession fears and rattling corporate confidence. Joining me now, we've got Julia Pollack, who is the ZipRecruiter chief economist. Julia, great to have you back on the program here with us. With what we were just mentioning, how have you seen some of the hiring freezes, some of the spate of layoffs start to impact the hiring propensity and the types of positions that are being filled by companies?
Well, hiring is very stable and steady in the United States at the moment, in that healthcare is the one place where hiring is much faster than before the pandemic. In other industries, hiring has actually been held back for over a year now. Tech has seen job losses for 2 years. Professional and business services has seen job losses for a year and a half. And uncertainty has been the key word for over a year. It's been inflation and interest rate uncertainty. Now that continues to be the case, but policy uncertainty has been added to the mix.
And so how would you describe the health of the U.S. labor market more broadly right now?
I think that the surge in inflation and interest rates really knocked companies off kilter and injected a tremendous amount of anxiety. It's as though it's kind of pushed them to the edge of the cliff. And that is why any further uncertainty, any further shock is so much more dangerous than it might otherwise have been. There are many, many companies, especially small businesses, that rely on credit card financing, for example. And so their financing costs are so huge that they don't know how they can weather the next storm. Each storm has come on the tail of the previous one before companies have fully managed to recover. And that's why you see such small shares of businesses now saying that this is a good time to invest and grow.
One of the statistics that we're continuing to monitor, or that's the metrics that we're continuing to monitor, is the average weekly hours. So this work week falling to 34.1. What does that tell us?
Brad, that is actually the key figure in this past jobs report that looked otherwise pretty good on the surface with a low unemployment rate and high number of monthly job gains. The weekly hours number, though, is very concerning because it suggests that companies aren't yet cutting jobs, but they're cutting hours. When I first saw that print in the previous report, I thought it was a mistake. I thought it was a blip. I thought it was due to bad weather in January. But that we saw that number again for February is concerning. And here's what it's caused. It's resulted in a big increase in the share of workers who are part-time for economic reasons, which means they can't find a full-time job. That's now the highest number since 2019. It also increased the share of workers who are multiple job holders. That's now the largest since 2009. So workers are cobbling together multiple gigs because their primary jobs are just not giving them the hours they need.
What within that data, because there are so many different ways to look at that. It could be people who are taking on different side gigs, or it could be freelancers who are putting together different contracts and having multiple companies or clientele that they work with. What is the biggest shift that you're seeing right now, especially as we've seen some of the stats come out and say how millennials and Gen Z are looking to make sure that they can lean further into either creator economy or freelance economy to decide how they work versus the traditional historical element of corporate work.
So you're right. The multiple job holding is a very complex phenomenon. Part of it is driven by opportunity, by a desire for flexibility, by a hot job market where people can take on multiple jobs and earn, twice as much as they might otherwise do. But part of it is also need driven. And where it's taking place now, it does look like it's mostly a response to cutbacks in hours. If you look at earnings across the two groups, across multiple job holders and people with just one job, they're actually very, very similar. And so this is mostly people who are losing income in one job or can't find one job that makes enough, taking on two so that they can just earn as much as someone with one job, not break out and earn more. That said, of course, there are many young people who are very excited at the ability to monetize unused pockets of time while studying, even while in high school, who are getting into the creator economy. And thank goodness that we have those opportunities, especially in times like today when the hiring rate in primary, regular full-time jobs is so low.
Julia, always a pleasure to get some of your insights. Thanks so much for taking the time here with us today.
Thank you.
Small business optimism is receding in February. The NFIB Small Business Optimism Index falling by 2 points last month, with the Uncertainty Index rising 4 points to its second highest reading ever. Here to dig into the details, we've got Holly Wade, NFIB Executive Director. Holly, always a great privilege to grab some time with you, especially on the publishing of this survey here. Just want to walk through broad strokes what you found in this most recent reading.
Yes, so small business optimism, as you mentioned, has fell off a little bit from its peak right after the election. We're still a few points above the 51-year historic average of 98. So small business owners in February still found themselves in, a fairly comfortable position in the economy, optimistic about things moving forward, especially from the previous year where the index was quite low, historically speaking. So there is still a lot of energy out there among small business owners, just tapered off a bit since right after the election.
And so with all of this in mind, how are we gauging the propensity for small businesses either to engage with consumers or, on the other side of that, how they're thinking across their hiring practices as well?
So for small business owners, labor is still the single most important problem for about 19%. So about 1 in 5 are saying that labor is their biggest problem in operating their business. We have still record levels of job openings, especially in those industries related to now retail, construction, and transportation. So those are the 3 top industries that we're seeing from small business owners in having those job openings. Compensation pressures are still alive in the small business sector, with historically high levels of business owners saying that they have increased compensation to attract those applicants for those open positions, to retain current employees. So the labor market is still strong. 13% or 12%, sorry, say that labor costs are their single most important problem. So that's driving some of the inflation pressures that small business owners are seeing. And then there's the uncertainty index, where that has spiked quite significantly over the last couple months, with more small business owners not confident about kind of what to expect in the next couple months as far as the conditions of operating their business.
How are their balance sheets holding up right now? Because that's one of the kind of data points that you're always able to really kind of read through as well. Those who are needing to either tap loans in this near-term period of time or able to at least offset some of the concerns for their balance sheet by raising prices. How are they kind of going about that calculus?
Well, inflation is still one of the bigger problems for a lot of small business owners. That is still registering in our survey. But when we ask about, their assessment of the health of their business, about 2/3 of them say that their business is doing good or even excellent. So, the majority of small business owners evaluate themselves as their business looking pretty good in this current economy or in February. And as far as borrowing, we've seen a slowdown in regular borrowing among small business owners, but that could be because we have seen a real slowdown in capital expensing plans. So, investing in their business in uncertain conditions, isn't moving forward. More small business owners are scaling back on those plans, not borrowing. Could be certainly because of those higher interest rates that they're experiencing. So cost of financing is expensive for many of them. And then just the level of uncertainty that they're anticipating or that they feel right now is leveling off some of those investment plans in their business.
How are small businesses, from what you can best gauge right now, thinking about and preparing for the reality of tariffs that has now been in a tit-for-tat form, especially with some of the new ones that have just come out and been announced today?
Yeah, so that is proving to be an area of uncertainty, of concern for small business owners in trying to figure out whether those tariffs will impact them, how it will impact them, either directly or indirectly. In our survey for the month of February, there was a lot of discussion, kind of planned developments of what the tariff landscape might look like. They were in the environment of the increase on Chinese imports, that 10% tariff that took effect in February. So the next couple months of our survey, we'll have a better idea of how those tariffs develop, how they're impacting small business owners and what sectors are being particularly hit by the impacts of tariffs as they develop.
Holly, thanks so much for taking the time here with us to break down some of the most recent findings. Appreciate it.
Thank you.
Let's get a check of the markets right now as we're taking a look across the major averages 2 hours into today's session. We have seen the NASDAQ dip back into negative territory. It has touched both negative and positive territory throughout today's session here. It's flat just barely to the downside right now. The Dow is still down by a little more than 1%, and the S&P 500, you're seeing that down fractionally by about 0.5%, 0.6%. However you want to round that off. Next up, inflation is becoming a major problem for retirees. We talk about that next on Wealth. Two hours into today's trading session, let's get you a check in on the markets right now. And I wanted to hop over to the Wi-Fi Interactive just to give you a glimpse and put some of the action. Let's put some candlestick action on what's taking place here today. All right, and here's where we're going to point out a few of the major candlesticks that have taken place. You did have a little bit of this rebound green candlestick that happened just after 11 a.m. after we came on air here for Wealth, but here were the ones that I was keeping close tabs on earlier. This was taking place during Catalyst. This was as you saw President Trump and the announcements around the additional 50% aluminum and steel tariffs that were coming through and rattling through the markets here. And particularly, I was taking a look at some of the candlesticks across the major averages back at my desk, and some of those larger ones stuck out to me that had really started to push the markets towards their intraday session lows. But as you can see right now, we've moved off of some of those session lows right now, and this green candlestick had a lot to do with that just after the 11 a.m. marker. Let's take a look at the NASDAQ composite here. Similarly, just after the 11 a.m. marker, big candlestick to the upside. That's what got us back into positive territory, but ultimately we've seen a considerable amount of hyper waffling on the day as the NASDAQ composite, the tech-heavy average, tries to make up its mind here. We'll dig into tech in just a hot second as we take a look at the sector basis. Similarly here, same case for the S&P 500. Some big post-AM candlesticks to the downside there, but then additionally one big one after 11 a.m. that still has us in negative territory. We're down by about 0.4%. So we've got 2 out of the 3 major averages still in the red, but the NASDAQ trying to find its way as that's been hyper waffling here on the day. I mentioned technology. I want to pop on over to some of the sector activity. We're done with our candlesticks, but we're going to take a look at some heat maps here for a hot second while we have a moment. And taking a look at the sector activity on the day, 11 S&P 500 sectors we've got loaded up here on the screen, and it seems like, and let's put this on intraday, it seems like as you're seeing a sea of red, there is just one barely by the hair of its chinny chin chin gainer on the day, but it depends upon when you check in on it. And technology, flat just barely to the upside here, and it's not even fully registering here. It still says essentially unchanged or flat, but trying to find its way there as we're seeing all of the major averages led lower right now by industrials. Industrials is down by about 1%. We'll just ride out with a quick look at the NASDAQ 100 here intraday. Apple, which we're going to dive into just a little bit deeper on later on in the show, that's moving lower, leading the Mag 7 lower by about 3% right now. More Americans than ever are expected to retire this year, and some of these pre-retirees are facing challenges. 67% of those planning for retirement say that they're confident about their prospects. That's actually down from 74% last year. So what is behind this big drop? Joining me now, we've got our very own Carrie Hannon. Carrie, why are fewer people feeling confident about retirement?
Yeah, Brad. I mean, this is an interesting finding that it's from a recent Fidelity report. And it says that, these pre-retirees are really, it's sinking their confidence. And it shouldn't be surprising to our audience here. It's they're caught off guard by rising prices. And so this has gotten them really, especially healthcare costs, have them concerned about, are they able to continue to save for retirement because their day-to-day living costs have come up? Another thing in that survey that was also interesting is they looked at people who are currently retired. And these folks, 7 out of 10 are actually pretty confident. That said, their one big niggle is that they say that their medical expenses in retirement, are much higher than they expected. And 20% of them said they wish they had worked harder at paying down their debt from credit cards and mortgages, et cetera, before they were retired. And, Fidelity has a number that individuals should plan on having $165,000 post age 65 to pay for after out-of-pocket medical costs after Medicare. So that's a pretty big number. And I think a lot of people don't focus on that possibility and plan for those costs for medical care.
Carrie, let's talk about credit card debt. Nearly half of older Americans aged 50 and up carry a balance on their credit card month to month, according to AARP. Carrie, why are they holding this debt, and how does that debt impact their abilities to save for retirement?
Yeah, bro, this absolutely freaks me out because this is such a dilemma, because if you have credit card debt, and we're talking the average credit card rate for people who roll over debt month to month is 20%. This is a huge amount of money that they're paying in interest on these credit cards. If you're paying down these credit cards or paying off credit cards, it's so hard to set aside money for retirement, to save for retirement. And if you're 50, you've got decades to go, right? You really need to be saving. So that's a real problem. And a lot of these folks are relying on their credit cards to pay day-to-day living expenses. So it's not just, it's really this impact of high inflation that's hitting them hard. And they're saying costs are just going up more than I expected. So this is a dilemma. And so the other thing is, so we have these out-of-pocket medical costs that a lot of people are using their credit cards to pay. That is really, really daunting. So I think they also say cars are an issue and also housing, but they're putting these things on their credit cards and they're revolving the debt. So you gave that number of people having over $5,000, I believe you put that up, but there's a good chunk of people that actually have over $10,000 that they're revolving on their credit cards. And at this stage in life, you really need to take control of these debts because, as we learned from the Fidelity report, this is a big regret that people have in retirement, is that they retire with debt, and it makes it really a struggle.
Carrie, thanks so much for breaking this down for us. Appreciate it.
Thanks.
A programming note: in this week's episode of Decoding Retirement, host Bob Powell speaks with BlackRock's Nick Nafusi about some common retirement misconceptions that you need to know about.
We talk about time horizon a lot. If I think about retirement planning, it is almost always a long horizon. And what we do is we get inundated with short-term news. And if you think about short-term news versus planning for retirement, they're two very different things. So just think about what's going on today with tariff talk, inflation talk. These things are short-term. When we think about retirement planning, somebody in their 20s, they're going to spend 45 years investing for retirement. And then at 65, you still have a very long time horizon of, on average, 20 years. So add the two of those up, we're looking at a huge time period here for planning. Even somebody that's 55 years old, they're not going to retire for 10 years. The reason why time horizon is so important is the longer that you're in the markets, the better the probability is you're going to be successful.
You can catch episodes of Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Quick check of the markets as we go to break. We are mixed right now. The NASDAQ has moved just a little bit higher, edged to 0.4% in the green here, as we've seen it touch both positive and negative territory here today. The Dow and the S&P 500 are still in negative territory. However, they are off of their intraday session lows here. Fractional declines for the Dow and the S&P 500. Coming up, this year's tax refunds bigger than last year. We have tips to help you make the most of yours. That's next on Wealth. It's tax week on Wealth, and we've got everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. Today, we're talking about refunds, because why not? That's the fun part of it. New data from the IRS shows tax refunds are larger this year than last, up an average of 6.3%. The total number of refunds is also up by 1.7%. Joining me now is Andrew Gordon Tax Partner. All right, so we got to know what factors are making some refunds bigger this year, Andrew.
Yeah, Brad, it's great to be here, and that's correct. We're seeing in our practice that more clients are actually getting refunds this year, and that's because of two general factors: the factors that they can control, and then those that they can't, the general tax code changes. Now, first, in terms of parts that they can control, one of the most significant credits or deductions is the child tax credit. And so if you had a kid during the year, you can get an additional $2,000 of credit for your taxes. And up to $1,700 of this is refundable or will be paid directly back to you. Another big change potentially during the year is an investment in an EV or a electric vehicle. If you purchased one during the year, there's another credit that you might be eligible for. But then moving to the changes to the tax code itself, we saw that the standard deduction, which many people take instead of itemizing, in fact, increased this year to $14,600. And at the same time, the tax brackets themselves, the amount in each bracket increased with inflation. So if your income stayed exactly the same, you'll still get a larger refund because there's larger tax brackets.
And so with all of that in mind, two of the things that you mentioned are up in the air as to how large those credits will be going forward, even if we do see more of the continuation of the Tax Cuts and Jobs Act 2.0. And specifically, I'm thinking of the child tax credit and then additionally the EV credit, as on day one, President Trump had talked about rolling back some of those incentives. So how will that make the next tax filing season next year even more of a different or a comparable significant change?
Yeah, that's right, Brad. The Tax Cuts and Jobs Act, which was passed several years ago, is actually set to expire this year. And two of the key provisions, the child tax credits and EVs, also set to be reduced if this lapses. Now, President Trump has indicated that he wants it to continue, and in fact, to increase some of the deductions as well. And so there's a lot of hope that it will continue and that these deductions will exist in future years. But for now, it's yet to be seen.
And so how can you adjust your withholdings if you're getting a large refund? Because that essentially means that you're loaning more to the government than you need to on the outset in pre-tax dollars.
You took the words out of my mouth, Brad. If you're getting a large refund, it's not necessarily a good thing. I hear from people all the time, hey, I got a large refund. But the reality is that you've given the government an interest-free loan. And that's because your refund is the difference between your withholding and the tax calculation come filing time. And so if you're paying too much in withholding, you're going to get a large refund. And so a way to counteract that is to reduce your withholding. Now, at the end of the year, you might get less of a refund, but that means more cash in your pocket every month.
Okay, you got some tips for us to help make the most out of your refund. What are they?
So you've got more cash in your hands now. Let's put it to use. And one great way to do so is to pay high interest loans, be it student loans or credit card loans. If you've got some high interest loans, let that money be put to work and let's reduce them. Another way is to invest in retirement. A way to reduce your taxes is through tax-deferred retirement accounts. And now that you've got more cash on hand, perhaps increase your investments in retirement. Interest rates are also high right now. So rather than just having the money on hand, put it into a high interest savings account. And finally, consider bolstering or building an emergency fund. You never know when you might need some additional cash.
Andrew, always a pleasure to grab some time with you. Great insights and tips for our viewers out there. Appreciate it.
Thanks, Brad.
Let's get a check of the markets here as we're near lunchtime. We're just about 10 minutes away here, at least on the East Coast. Sorry for you West Coasters out there. We still love you anyway. Taking a look at the Dow, the S&P 500. Right now, both of those indices are lower. Fractionally, the Dow, the worst of the decliners by about 0.75%, we'll call that, and 0.3% for the S&P 500 in the red. 0.3% in the green, you've got the NASDAQ composite. Coming up, why Apple's next round of artificial intelligence updates are delayed. That's coming up next. Apple Intelligence debuted last fall with features like writing assistants and AI-generated emojis, but users will have to wait before getting an AI-enhanced upgrade to Siri, with Apple saying in a statement, quote, "It's going to take longer than we thought to deliver on these features, and we anticipate rolling them out in the coming year," end quote. Joining me now, we've got Yahoo Finance tech editor Dan Howley. Dan, what kind of features are users waiting for here?
Yeah, Brad, I think the big thing here is the smarter Siri, right? Siri was kind of the first kind of smart assistant, and it just doesn't live up to those expectations anymore, and it hasn't for quite some time, frankly. It kind of petered out when we saw Alexa and Google really kind of come into their own. And how many times you said to Siri, set a timer, set a timer, set a timer, and finally it sets a timer. And what else are you doing with it besides that, right? So that's the idea of what this new Siri is supposed to be. It's supposed to be context aware. It's supposed to understand your information, so you can say things like, okay, when do I have to go pick up mom from the airport? Let me know that, and then show me the correct route. And it'll do all those things, kind of agentic AI-esque. And so, it's one of those kinds of features that we were kind of expecting to see by now. At some point. There's the ability to control apps that kind of goes into the agentic AI, and then the analyzing what's on your screen, something look Google can already do, Samsung can already do. And so we're waiting on this, but one analyst I spoke to, let me just get this right, said that it's been a debacle ever since they launched Apple Intelligence. Another said that there's no short-term fixes here, and they might not have this capability for the new Siri until something like 2026. And 2022 is when we saw ChatGPT really pop off. The end of it, just to be fair. But 2026 to kind of get Siri, an upgraded Siri, then not too great.
I got to hustle to our finish here, but we got to ask about this. We got reports that Apple is planning on a massive overhaul of its software interface. What do we know about that so far?
Yeah, this is from Bloomberg's Mark Gurman, and essentially it's supposed to be the biggest overhaul for iOS, iPadOS, macOS in years. And so that would just mean kind of a newer, fresher look. If it goes along with the new iPhone that's expected to come later this year, the iPhone 17, it's supposed to be a much thinner design. The overall look is supposed to kind of fit with what they have from the Vision Pro, the Vision OS, the operating system that runs on the Vision Pro headset. It's the general direction that they're looking at. We will find out more at WWDC. That usually happens in June. I get to sit out in the hot sun, melt for a few hours, and then send reports back here. But that's usually when we find stuff like that out. Maybe we'll get more about the AI capabilities that Apple is hopefully going to bring forward. But it was that time last year that they talked up Apple Intelligence, and it'll be a year, and we still don't have that new version of Siri.
Meta has called this the pivotal year for the metaverse. Do you think the same holds true for Apple?
I think, for Apple, what it comes down to really is outside of, the headset that they have. If they want to play in that space, it's got to be a new pair of smart glasses. And that's something that, there's been talk about. Mark Gurman, again at Bloomberg, has said that they're working on that actively, that it's something that, they want to see. But, I mean, the Vision Pro is great. Technologically, it's incredible. it's not the volume seller. It's not going to get them there.
Dan, thanks so much for breaking this down for us. Really appreciate it.
Sure.
Let's do a final check of the markets. With the time we have left here, the Dow and the NASDAQ are in different territories right now. The Dow is lower by about 0.8%. The NASDAQ has been, for much of the hour, holding on to these gains and staying in positive territory, at least oscillating between gains and losses. It's up by about 0.25% as we leave you. The S&P 500 down 0.3%. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination at 3 p.m.